Let's say that you have a bad investment within your taxable account, otherwise known as a brokerage account, and we want to exit that investment and invest in something a bit more tax efficient. Well, how do we do so and make sure it's a tax win for our situation? Now, we know there are a few variables we have to try to consider here. If we exit that investment, there's likely a tax cost that we need to overcome before it becomes a tax win. Well, in this video today, we're going to talk about 5 absolutely critical variables that you need to be considering to make sure that you're exiting that investment as tax efficiently as possible. But let's first start with an example to talk through why tax efficient investing is so important within these accounts. Now on the screen I have 2 investments that we're comparing here. I have the American Fund's Growth Fund of America, which is a mutual fund that is a fairly tax inefficient mutual fund, and I'm comparing that to the Vanguard Growth ETF. And when we compare these head to head, I'm going to label the Growth Fund of America as a bad taxable account investment. Now, do not take any education within this video and take this as advice for your specific situation, but you'll see why I label this as a bad taxable account investment. When we compare these head to head, we see that they're both large cap growth funds, which means they will be highly correlated together moving forward. But nonetheless, we see a performance difference for a few different reasons. The American Growth Fund of America is an active mutual fund. And so we see the active management of this mutual fund, as well as the added fee that this mutual fund costs investors, drags down performance in a pretty big way. Going back to 2006, we've seen that there's basically a 1.5% performance difference between the ETF and the mutual fund. We see that the max drawdown is quite similar, so the risk is quite similar between these 2 funds. We see that the expense ratio of the mutual fund is more than 10 times that of the ETF. And one of the most important things when we're talking about a taxable account is the forced income that investors are forced to take from each of these given funds. We see the annual distribution from the Growth Fund of America on average is about 8%, meaning that on an ongoing basis, investors are forced to take about 8% of that fund each and every year and pay taxes on that. That is a huge tax drag versus the ETF that is less than 1%. And so we see that both of these funds are very comparable in terms of what they invest in, but one fund is costing investors significantly more. Well, just how much more? Well, if we take both of these given investments and we use their historical differences and we run a quick illustration for what we should expect from both of these funds, we will see that if we invest $100,000 into each of these funds over a 20-year time period, we would expect the growth mutual fund to grow to about $474,000. Now, this is far and away from what you would expect from the growth ETF, which would grow to $681,000. And there's 2 important reasons why this is the case. The first is obviously the performance difference that we just showed. A 1.5% extra per year will make a huge difference. But the other very important variable, especially with a taxable account, is the tax drags that we expect from that mutual fund. Again, if you're taking 8% distributions on an ongoing basis, paying taxes on those, that is less money that's invested in building towards your betterment in the future. And so we have a lot of videos that we talk about on the Safeguard Wealth Management YouTube channel where we talk about why tax efficient investing is so important. And this really illustrates exactly why. When we have dividends and we have capital gain distributions from mutual funds, that simply drags down our performance and only costs us. And so we need to be investing more tax efficiently. Well, let's say you're invested in this American Growth Fund of America and you want to exit this for the growth ETF that we're showing here. Well, it may not be as simple as first meets the eye. Let's take an example here, and let's say we currently have $120,000 within that growth mutual fund, and our cost basis is $50,000. So if we sell this given investment, we have $70,000 of unrealized gains that we're going to pay capital gains tax on. Well, let's say this is long-term capital gains of 15% here, just for simplicity. Well, that would cost us $10,500 in taxes to exit one investment and roll that into the new investment. Well, in this example, we're going to say that this investor passes away in year 2. Well, if they would have exited in year 1 this mutual fund and invested that and rolled that into that ETF, well, that tax cost would have weighed pretty heavily because there's something with taxable accounts called a step up in basis, meaning that if you have an unrealized gain and you pass that on to the next generation, that unrealized gain is completely wiped out. So if we look at this investor exiting this bad investment and passing away in year 2, we see that this investor simply lost those tax dollars. And so with this, we see there has to be a break even. Now, at some point, investing in the more tax efficient fund, because of the performance difference and the ability to avoid tax drags, will overcome this tax cost. But when does that break even happen? Well, the thing is, everyone's break even is going to be different. Well, here are 5 variables you absolutely need to be considering. The first is the unrealized gain in the current position. So how much will we need to incur as long-term capital gains or short-term capital gains in order to exit that position? And then what is the tax rate that we are paying at that exit? We then move on to what is the expected performance difference between these two investments, what is the expected dividend tax drag difference, and then what is the expected given turnover or capital gain distribution difference between these two investments. Now we can really just group these into 2 different categories: the expected cost to exit and then the expected improvement from investment A to investment B. If the cost to exit is fairly low and the expected improvement is fairly high, well, guess what? Your break even is going to be pretty close to when you exit those given funds. On the flip side, if the cost to exit is very high and the expected improvement is just slight, it's going to take you a lot longer to break even on that initial tax cost. Now, we're going to go through a bunch of examples to help you understand how to weigh these given differences. But let's first close the loop on that first example that we showed. What would be the break even from exiting that mutual fund and investing in the more tax efficient ETF? And we can see with this chart that the break even happens in this specific example when we have a $70,000 unrealized gain. That break even on that tax cost happens between years 4 and 5. Once we're past year 5, then it's all upside from there. Now, one thing to understand here is there are 2 ways to look at the break even. Now, we're using the more conservative way of looking at the step up in value break even. What this means is we're assuming we don't ever have to exit that bad tax efficient investment. We can simply hold that to the end of our life and pass on that unrealized gain to the next generation. The reason I say this is more conservative is because this is going to be the longest break even that you have. Another way of looking at this, however, is the liquidation value. Now, you would look at the liquidation value if you were planning on using these funds for your retirement. And so understand that the break even in that situation is far sooner. The reason for this, if you think about it, if we were to exit that $70,000 unrealized gain and invest more tax efficiently, well, then we're taking a tax cost. Well, if we're planning on using that money at some point in our retirement anyway, we're going to be incurring that tax cost either way. And so the only thing we're factoring in then to that break even is essentially the return on investment that we could have earned had we not taken that tax cost. So what we see with the liquidation value is the break even happens within the first couple years in most cases. Hopefully that makes sense. I know that can be a little bit confusing. All you need to understand is for the continuing break even points that we're going to be looking at, we're using the most conservative estimate. Well, let's first look at a fairly simple comparison. When we're comparing, let's say, a tax inefficient mutual fund to exiting and investing in something a little bit more tax efficient like an ETF. Well, let's say there's a 6% turnover difference. So what this means is essentially with a mutual fund, we might have 6% worth of capital gain distributions on average at the end of the year. With an ETF, we shouldn't have that. And so if we just look at that tax drag difference and we look at the same performance, when is our break even? Well, I have 3 different charts on the screen, each of these charts showing a different unrealized gain. And if we have a small unrealized gain and we're trying to invest in something more tax efficient, eliminating the tax drag, we say that the break even happens around year 6. So there's a little bit further of a break even when we're leaving out a performance difference. As we look at larger unrealized gains that we currently have in that current position, we see the break even moves out further. And so we have 25% unrealized gains. We see that the break even moves out to around year 10. With 50% unrealized gains, the break even moves out between years 15 and 16. Now, I think these 3 charts really show just how important tax drags are. Within each of these scenarios, even having some fairly large unrealized gains, there is a break even within 20 years. But depending on what your time horizon is, you need to be weighing whether that tax change solely on tax drags is worth enough, and you'll see that break even within your given lifetime. In the next set of examples, we're going to keep the turnover drag that we've been using, but now we're going to layer on either a percent performance difference or a percent fee difference. And so with this scenario, what you'll see is the performance difference ends up making a pretty big impact on these break evens. For instance, with a smaller 10% unrealized gain, we see that the break even happens between years 1 and 2. Even with the larger 50% unrealized gain, we still see that the break even happens between years 5 and 6. And so understand that tax drags are important, but if we can layer on an expected performance improvement or fee improvement understand that it certainly moves that break even much closer. Now, in this type of situation, for most investors, we're going to see that the intersection of these two improvements make it so that most investors should make this tax change. Now, before we go on to the next slide, I just want you to make a note of this middle chart here. We see that with 25% unrealized gains, paying a 15% tax rate on exiting that bad investment, we see that the break even happens around year 3 here. Now, next what we're going to show is if there's a different tax cost, a different tax rate that you're paying, and how that changes these given break evens. And with this, what you'll see is that if we have 25% unrealized gains, and we happen to be in the 0% long-term capital gain bracket, well, now there's only upside. We have a turnover tax drag that we're improving on. We have a performance drag that we're improving on. And we see that there is only upside. There is no break even. And this makes sense because there's not a tax cost to exit. Now, thinking back to the last slide that had a 25% unrealized gain paying 15%, now we're jacking that 15% up to 23.8%. But it only moves back the break even 2 years. So we see that jacking up that tax cost does make a difference, but it wasn't as big of a difference as most of us probably think. If we try to look at balancing these break evens, there are some important takeaways that, well, we can take away. First, that expected improvements typically can trump the cost to exit if those expected improvements are large enough. In terms of cost to exit, we see that the tax rate that you're paying has less influence on the break even than the amount of unrealized gains you have, and thus the tax cost based on those unrealized gains. If you have significantly larger unrealized gains, those break evens are typically going to be further out than if you have smaller unrealized gains, but you're paying a higher tax cost to exit. Now, on the expected improvement side, we see that the performance difference has the biggest influence on this break even. But the last thing I want to add to this discussion is coming back to just how important a forward-looking tax plan will be. As we take this out of a more theoretical box and we apply this into real-world planning, we know there are going to be better years to realize those gains and exit that bad investment versus other years. So knowing what your tax graphs look like on an ongoing basis is extremely important. So with that, if we're performing conversions and we'd be paying 18.8% on exiting an investment this year, it may make sense to wait until a period where we no longer have those Roth conversions, where we can pay either 15% or even 0% within those long-term capital gain brackets. Now, I understand that this break-even equation can get quite complex as we start to weigh all of these given variables. This is because there's so many downward tax pressures on taxable accounts. Any change that you make translates to a tax obligation that you now owe. Now, the good news is there's a lot of upside awarded to those investors that are willing to dig into these given complexities. To help increase your understanding on some of these variables, such as dividend tax drags and turnover tax drags, I have 2 videos right here that will help explain why controlling these tax drags are so important for your retirement. Always remember, you don't need more money, you need a better plan. Thanks for watching, and we look forward to seeing you in the next video.